Get your money out now. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the next big bombshell is about to hit U.S. banks in a big way. And this is something the banks have been trying to keep covered up in hopes that something would change. Perhaps that we would indeed see a soft landing and the economy would come roaring back and that nobody would notice what is going on in their balance sheets. But with what we're seeing as a slowing not only U.S. economy, but global economy, the U.S. banks are starting to be exposed for the massive amount of risk they are carrying. Now, I want to show you what's going on from a regulatory side first, what the central elites are saying, because what they tell us from one side is not going to be what they actually do. Because when they start to see this risk come unraveled, they're not going to be concerned at all about what the consumer price index level is or any other metric they've been telling us. And so we're going to take a look at this massive amount of risk you're going to see is starting to be exposed by the banks. And then we're going to look at just how damaging this is going to be to the U.S. economy as everything comes unraveled this year. Now it's over to Bloomberg, where we picked today's story up with a headline, and we talk about now from the perspective of the central elites how they view the banking system. As Goolsbee says, investors got ahead of the Fed on rate cut bets. And so what we've noticed here is the Fed kind of makes this position of we are acting on the data as we see it come in, and they always say that, and then they make some projections, and as soon as the market saw that there's some potential view that the Fed is going to cut rates, what happened is the market started to price in more than double what the Fed expectations were of 3 rate cuts this year. And part of the reason is the market sees things that the Fed can't see, and particularly when it comes to the banking system that we know based on past cycles. When the banks go, the Fed reacts in a big way, mainly because they are the banking regulators. As Goolsbee said, while the economic data on inflation is mixed, giving you the impression that that's really what they care about, if you take a step back over the course of last year, we've had a very substantial drop in inflation, which is absolutely true. Goolsbee's comments add to the chorus of policymakers this week who will push back against market expectations on a rate cut in March, saying it's still too early to be confident that inflation is sustainably cooling, a precursor to normalizing policy. And part of the reason that is the market is pricing in a cut in March is because they're looking at the banks right now and they're saying, wait a minute, there's a lot of problems here that apparently the Fed seems to be ignoring and the market's starting to get fixated on. And here you can see, of course, the Fed makes the claim that they care about the inflation and using the federal funds as a tool to control it. But what I wanted to point out in most of the yellow spots here, that the Fed, what we see in terms of the federal funds rate, leads inflation, shown as the consumer price index in blue, by cutting well ahead of course, any move down in inflation, or they're virtually in sync with the decline of it. There's only one major exception, and that was, of course, in the early 1980s, where the Fed maintained a highly restrictive policy, which turned into 2 recessions, and that, of course, brought inflation down in a big way. And now they want you to believe the same story is true, because as we look forward into the 90s and 2000, the Fed was virtually cutting every dime ahead of any drop of inflation. Now they want you to believe that suddenly inflation matters, but it doesn't. It's all about the banks, as you're going to see. In this case, I do think there was a little bit of a mix-up in the market about how the Fed Open Market Committee works, Goolsbee said, who does not, of course, vote on policy this year. We debate as a body, which is true, and vote on today's actions, also true. We don't debate and vote on the future. We don't make future decisions. That also is true, but they do make projections. And there's those projections, the fact that even the central bankers, even one of them, is thinking about a potential cut this year, tells the market that no, they're going to be cutting a whole lot more than that. And to the extent now that even the bond market, who is really the proxy for the federal funds rate, is telling the Fed, yes, you're going to be cutting and far more than you expect, and even sooner. And here you can see the federal funds rate in red against the 2-year Treasury yield in blue. And what we can note is the 2-year Treasury yield leads the federal funds rate to the downside, well, virtually every time. And you can see, of course, back in the 80s it was in sync, but now as we move into the late 80s, early 90s, and thereon after, where the 2-year Treasury yield goes, of course, what we can note is that means the Fed is going to follow. Now, the problem here is, what does the 2-year Treasury yield see? What is the bombshell that's sitting on top of the banks right now, ready to go off? Well, it is a big one. But let's now start and look at what's going on with the banks currently right now. And then as we look to the risks that's starting to be exposed, we saw it in the quarterly reports. It's only going to get worse this year and deep into next year. As 2024 starts with deposit flight from large banks, that's a problem because banks need cash. Loan volumes shrink. There's another issue because that's how banks make money. The trouble is brewing for small banks, which, as we've noted on the show, are largely insolvent. But Zero Hedge starts out their article by saying, after 4 straight weeks of inflows, this is money into banks, seasonally adjusted bank deposits saw $23.3 billion of outflows in the first week of 2024, suggesting that the problem with the banks is they desperately need cash. They don't have access to it. They've had to lend their security book to the Fed to get cash starting in March. This is why, again, the market, one of the reasons the market thinks there's a rate cut coming then is because the Fed has no choice but to end their emergency funding program to the banks. They have virtually no excuse to go in front of Congress and say why they need to extend it if indeed the economy is doing well. Of course, what that means is the market's starting to realize that the banks do not have the money to pay these loans back. That means the Fed's going to have to cut rates to get the banks' balance sheets from negative equity back somewhere into the positive so they can start selling off their assets to repay these loans. Now, if you're thinking, is this a good time to invest in the banks? And how would I know when it is? Well, we give you all the tools of that. And one of the ways we do that is by looking at the machine positioning every day. And you can do that too with our CTA Timer Pro report. So if you're thinking, hey, is now a good time to invest in the banks? The answer would be no, because our machine positioning already shows extended positions. We look at the fast machines, the ones that trade the market very quickly, and the ones that trade it even slower. As we look at the regional banking and the big bank ETFs, we see the machines are fairly long. And one thing we do that's unique is we run a historical overlay on this. So when we see extreme positions to the downside and it moves off that level, that's where you want to buy. And coming this month, our programmer is going to make it so easy to use the reports. And right now, there's 3 coupon codes for a 3-month free month. Grab that while you can. And then from a technical perspective, we have our Momentum Time Pro report that looks at things like the MACD and the RSI and those other signals, smooths them all out. And right now we look at technicals are extended on a 3-month or 1 month, 3-month and 6-month window. Their momentum is maxed out. Now is not the time. You want to wait for a big, deep reversal. Again, links in description for both. There is a 1 month, again, free month, 3 coupons for that. Grab them before they're gone. Now let's continue, because when the opportunity comes to invest in banks, our reports will let you know, because it's going to be one of the best opportunities you've seen in your life. In the meantime, the other side of the ledger, large bank loan volumes tumbled $16.6 billion for the 5th week in a row. Meanwhile, small bank loan volume rose $4.3 billion. And here's the problem, is when lending contracts in a debt-based economy, it leads to the destruction of money. So when you originate a new loan, let's say you have a $100,000 loan that gets originated, that's $100,000 created in the economy. Every time a payment is made on that loan, the principal value of that payment is destroyed. When you have on net a contraction in lending, well, that means money is being destroyed from the economy. And in a debt-based system, you need a substantial amount of new money created to support not only the growth targets, but the debt levels. So on net, when the commercial banking system is destroying money, it's not good, particularly when they need deposits. And when that happens, notably, the Fed tends to react. And it's a simple case of why, because when you see a contraction in lending, what does it tell you about interest rates? Well, if you said it tells you they're too high, you got it right. And sure enough, that's exactly what the market thinks on the 2-year Treasury yield. Here we see the 2-year yield in blue against commercial industrial lending. This had all commercial banks in red on a year-on-year rate of change, with that horizontal dashed green line showing where below that the red line goes. It's in contraction. And so what I want you to understand here is the bond market understands the banking system perfectly. So when lending starts to decelerate or even worse, contract, the bond interest rates just go down. It doesn't matter if the whole world is selling them. Doesn't matter how much the Treasury issues in terms of deficits. It doesn't matter who's short it, because in the end of the day, this is about the health of our monetary system. So when yields go down, why are they going down? To get people to lend. That's the key, to borrow money, to create money in the economy, to keep the system from collapsing. And notably, as we look to in the past, what do we see? Of course, commercial lending, industrial lending is contracting, and yields are going down in blue. You see decelerations in lending tend to go along with a lead of the 2-year Treasury yield in the bond market, and you see that happen over and over again. Right now, everybody has been so short, and you can get these short-term moves in the market where everyone's dumping and shorting the bonds and keeping interest rates up, and what is setting up is a massive collapse in yields. The opportunity right now isn't to be on the invest in the banks, but invest in the bond side. Again, check out our reports. It gives you all the tools you need to be successful. Many people say one trade's paying for years. One of our subscribers said paid for 10 years of his subscription prices, making this one of the easiest and least expensive ways to be a successful trader. Because without the help of the Fed's BTFP program, or Bank Term Funding Program, the regional banking crisis is back in a big way, and large bank cash needs a home, suggesting, as we see, small bank cash is below their reserve constraint levels. In fact, the only reason they're above it is this green line here, is they're seeing, of course, where the banks are actually looking and borrowing money. Well, of course, we don't actually see it. This is large bank cash reserves, but what we know is the usage of the Bank Term Funding Program is offsetting this. In March, Bank Term Funding Program likely ends. Banks have to start paying that back. The problem is they don't have the cash. So now you see the setup. The regulators don't see there's a problem here. The banks are hemorrhaging in a big way. And the next bombshell, which started to come out in the earnings report, that's going to get uncovered and blow up in a big way this year and next year, let's take a look. As bad office loans mount at Bank of America and Wells Fargo, suggesting that if you're running high balances there, it's time to get some of your money out, as net charge-offs at B of A and Wells Fargo rose during the fourth quarter, partly due to office loans. So net charge-offs is when, of course, they realize the loan is just not going to be paid, and they effectively put it into default. They have to pay that. Banks lose money here. Now, they also have to put money in reserve if they believe loans are going bad. And here we can see, according to this, happened based on their earnings released on Friday. JP Morgan set aside more reserves, suggesting they know that loans are going to go bad because of a deteriorating outlook on commercial property valuations. So the banks now are starting to get exposed for the risk that we told you about many months ago, that commercial real estate was going to cause a huge problem. And the banks did not want to acknowledge it for one simple reason. If you believe the soft landing narrative, if you believe what the Fed is telling you, then this shouldn't be a problem, because the economy bounces off, starts to grow, and people start demanding office space, valuations come back, and next thing you know, you can just smooth it all over. The problem is, that's not happening. And banks have been grappling with fallout from climbing office vacancies in the aftermath of the pandemic and financing costs that have soared as the Federal Reserve raised interest rates. That's caused a whopping 35% decline in office prices from a peak in early 2022. This according from a real estate analytics firm called Green Street. And this is an issue because a lot of these loans aren't just by the big banks. In fact, the big banks, they don't do a ton of commercial and real estate lending. Who does the most? The small and mid-sized regional banks, and they're insolvent. That was why I wanted to show you their setup. They are insolvent. The Fed's going to have to drop rates here to bring their solvency levels up, because if they start to get a wave of defaults in their commercial property and they have to eat those losses, well, they don't have any money. In fact, they don't have any money now. The challenges won't likely let up soon, as B of A has about $7.6 billion of office loans maturing this year and $3.1 billion maturing next year. While about 75% of its office loans are backed by higher quality buildings, its percentage of non-performing office loans ticked up in the fourth quarter, validating what we know to be true is we're not heading into a soft landing. We're heading into a global synchronized recession. And because the banks are in such dire shape, we already know a financial crisis is in the cards. And as expected, losses started to materialize in our commercial real estate office portfolio as market fundamentals remain weak. This according to Wells Fargo's CFO. While the charge-off we took in the fourth quarter were contemplated in our allowance, we are still early in the cycle. Commercial property loans accounts for 16% of Wells Fargo's total loans at the end of December. At Bank of America, it was 6.9%. So here you see Wells Fargo acknowledging the truth here, that we're early in the cycle. We're already starting to experience charge-offs, and it's only going to get much worse. In fact, it's going to get bad, as we can see here from this article from Zero Hedge, that office vacancies hit a record high across U.S. cities as CRE downturn worsens. And so you can think about this perspective as we head into a recession. What happens? People lose their jobs. Office space gets consolidated. Demand goes down. Of course, that means the valuation of many of these buildings is going to outright plummet, putting huge stress on the banking system. And you can already get the picture. The Fed could go to zero in this perspective, and it still won't save the banks. That is a problem coming. And courtesy of Federal Reserve's most aggressive interest rate hiking cycle in generation, a surge in remote work and post-COVID world imploding. Democrat-run cities, this by Zero Hedge, with radical progressives in City Hall who failed to enforce common sense of law and order, the office sector is reeling and faces an accelerated downturn. Now, data from Moody's Analytics shows that 19.6% of office space across major U.S. metro areas was not leased as part of the fourth quarter of 2023, exceeding a previous high of 19.3% on the commercial real estate downturn between 1986 and 1991. So we're setting up for a massive crisis. And you can see the vacancy rate. You talk about the bombshell that's going to drop on this. The vacancy rate is now at all-time highs and heading even higher because we're not officially in recession. We're not even seeing a big surge in layoffs. If indeed what we saw in the initial claims data on the non-seasonally adjusted basis that we talked about on Thursday is even remotely true, we're setting up for, unfortunately, a lot of Americans to lose their job. That means a huge decline in demand for office space, and the banks are sitting on this because in the past, the idea that you could lose money on an office building is just, nobody thinks about that. In fact, there's no evidence to suggest valuations always go up. That's why investors love them. Until you find out no one's in them, and then the values plummet. The bulk of the vacant space are buildings that were built in the 50s, 60s, 70s, and even 80s. The new record directly reflects the remote and hybrid work trends that have surged since COVID as companies reduce overall corporate footprints. And of course, they demand newer buildings with newer amenities, nicer stuff, and there just isn't enough of. There's plenty of those. The problem is no one wants these old buildings. In fact, the only people that want them are the banks, and they're going to get stuck with them in a big way. In a previous report, the Mortgage Bankers Association found that $117 billion in CRE office debt needs to be repaid or refinanced, well, this year. That debt is concentrated in Democrat cities like New York City, San Francisco, Chicago, and Los Angeles, mainly, of course, what we know as major metropolises where there's a lot of office buildings and a lot of office space. And these cities are not prepared for what's coming to them. And you think about this from a taxation side, of course, all the revenue generated in taxes from having these buildings and real estate, well, what's going to happen is the banks aren't going to be able to pay that either. That's going to be a political problem for many of these municipalities. And unless the Fed aggressively begins cutting rates in March, which we believe is true, building owners' ability to obtain financing of previous loans will have trouble rolling over that debt. And why is that? Because on net, banks are tightening lending standards. The move down in the 2-year yield here recently suggests that financial conditions are tightening, not loosening. It means banks less likely to lend. Of course, it makes no sense when you think about they're the ones holding the same risk. And it's only mean regional banks with high exposure to CRE space could face a tsunami of credit losses over delinquent CRE loans, meaning they're likely to go upside down and out of business into bankruptcy. And now you look at this, we talked about CRE, but look at the other bombshell. Credit card delinquency rates are climbing to decade high now, according to the Fed. This is a big problem because when the consumer stops spending, well, they don't need as many jobs. Those jobs directly affect those who work in buildings. They lose their jobs. More buildings come open. What that means is when those loans come due, the banks can't refinance them because no one has enough money to buy down the value of the building. The property owner turns the keys back to the bank. Banks go insolvent. You get the picture here. All-out financial crisis, Fed back at zero, and that won't make a darn bit of difference. As credit card delinquency rates have exceeded pre-pandemic levels, while the share of borrowers making only the minimum payment climbed above 10% for the first time since 2019, suggesting that we are not seeing a big boom in the economy, that indeed the soft landing is turning into a deceleration to the downside. In fact, almost 3.2% of card balances were at least 30 days past due as of the end of September, the highest figure in more than a decade, and up by over 40 basis points from the previous quarter. The share of debts that are 60 and 90 days late are also jumped. And this is exactly what happens when banks tighten lending standards, constrict the creation of credit. What takes a while for the money to be drained out of the economy. This is why many people said, well, if it hasn't happened yet, then we're not going to see a recession. The pandemic stimulus drugged this thing out a long time. Now you're starting to see all the evidence of currency shortages all around the world, and it's finally hitting home, as we suggested it would. Meanwhile, the 2-year Treasury yield is telling us exactly what's coming, and that means the delinquency rate, which is shown in red when the 2-year yield falls. Of course, why is it going down? Because it doesn't want people to be in delinquency. It needs lower rates so people can try to make those payments. The bond market is just telling us that this is going to get worse in a big way. You can see 2-year yields declining as delinquency rates rise, meaning yields need to fall enough where people can actually afford to pay on their debt. Of course, if they're all lose their job and unemployment, well, yields are going to have to fall very, very far because they're just not going to have the money to pay. And responding to the signs of greater consumer fragility, banks are granting fewer credit line increases. No surprise, this happens when you tighten lending standards, and reducing limits more frequently. Again, not a shock to us. Its data covers loans by large banks with at least $100 billion of assets. This from the Philly Fed. At the same time, banks are cutting back borrowing limits, which means that consumers are tending to use more of their existing credit lines. Roughly 1 in 10 credit card users has a balance that reaches 95% of their limit, and a similar share only make the minimum payment every month, the most since 2019. If you remember 2019, we were headed into a recession. It's getting very clear. Any notion that we're going to see a soft landing, that's out the door. The only question is how bad this next financial crisis is going to be when the bombshell explodes on the banks this year. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.